Good evening, everyone. I welcome you to this short session, the aim of which is to provide clarity on what we discussed in one of our sessions on financial instrument, on the standards on financial instrument. You will recall that the standards of financial instrument include IAS 32, IFRS 7, and IFRS 9, essentially those three standards. So, as promised in our last revision class, I promised to offer clarity, especially to the correct treatment of the second bond. That's this bond. So that we can be better guided for the forthcoming examinations. So that's the whole essence. So let's just take a look at the question again so that we will know how to deal. So I will run you by this question again, then I would show you my screen. Permit me to show you my screen. So I'll come here and click on this. So you will agree with me that this is the question that shared in class. This is the question. And I'll quickly roll into it so that we can be on the same page. Let me zoom this thing in so you can see more clearly. So Just International PLC purchased two bonds on 1st January 2023. Details of the two bonds as follows. The nominal value of the bond as seen on the screen, 47.25 million for Sapa and 31.5 million for Steeze. Coupon rate 4%, purchase price of bond. So 40.425 billion for Sapa and 29.4 for Steeze, an effective yield as shown on the board. So we're also told by the question that the Sapa bond was bought with the intention of keeping it for a long time and withdrawing the interest and principal as a full due. I want us to pay attention to this statement with the intention of keeping it for a long time. Intention of keeping it for a long time. So that's the defining part of the attribute of that bond that will guide us as to the treatment we are to apply. However, for the Steeze bond, it was bought at deep discount, and the aim is to wait. It is to wait till when the market value increases and it sells for what? For profit. I also put that one also in bold. Let me color them properly so that it can give us a better focus. Yes, better focus beyond just bolding them so that we know what and what to pay attention to. So it's not the cocoa, actually. Sorry, it should be the Steeze bond at a fair value of 28.875 million as of December 31st, 2023. In both situations, the coupon which is due on 31st December has been paid as agreed. So we're now required. So to show the financial reporting treatment required by IFRS 9 for the year ended 31st December 2023, show all workings. So this is the question. We can see it again. Yes, can see it again. Now, the implication of this is that the Sapa bond is to be accounted for using the amortized cost. That's the meaning. So that's the meaning. Is to be accounted for using the amortized cost. And the amortized cost requires that you prepare that schedule, determine what the effective, interest rate is, which will increase the in-depth or the value of the bond. And of course, when payment is made or received, you deduct same. The closing value becomes the amortized cost. It continues that way till the end of the life of that bond. Unfortunately, by the nature of this question, we were not told the tenure of the bond. So the tenure of the bond, but we can just simulate it up to about a year or two, or if not 3, so that we know, particularly for Sapa bond. However, for the Steeze bond will not be accounted for using the amortized cost method, because it's not to be amortized, so it's to be accounted for using the fair value approach. Fair value, it's a fair value. So it's a financial instrument at fair value. So it's a financial instrument at fair value. And the rationale is not far-fetched. The rationale is simply because GOT intends to take advantage of, bullish trend in the market, by which time the bond would have gone up in value and the instrument then sold at profit. So it does not have the intention of keeping that bond for a long time. And as such, we are to treat it at fair value. We are to treat it at fair value. So that was one area in class that, there appeared to be some mix-up. And so how then do we deal with this? So I will deal first with the Sapa bond. The Sapa bond. So you come with me. I put this down and I share my Excel file. So stop sharing this. Then I bring in my Excel file so that we can run through it together. And of course, we have the instrument. We have the years. We have years 1, year 2. I've said year 3, year 4, year 5. Let's just simulate. So let us simulate. So to simulate, we have it this way. So preparing it, we are talking of the opening value, the opening value of the bond, the opening value of the bond. Of course, in year 1, that represents the purchase price. Then effective interest rate. Effective interest rate will be here. Effective interest rate. Effective interest rate. And of course, coupon paid or coupon received, the interest rate itself. So since it's an investment, you can say interest received. Interest received. So before you now have amortized cost. So before you now have amortized cost. Before you now have amortized cost. So carefully, just follow what we're doing here. I bold all of this. Let me do my formatting properly to allow for clarity. Okay, yeah. I hope you're following. I hope you're following. Good. All right, so the opening value here is the purchase price. And you agree with me that the purchase price is 40.425 million. So let me put all the figures there in accounting numbers so that can make my life very easy to decimal places. So of course, all the figures are in million. Don't let us get carried away by what we're doing. So Naira will also come here. Will also come here. And of course, and this one will also come here. So let me put all of this in one single jacket. Put all of this in one jacket. Yeah. Brilliant. Yes. Let me zoom it in so we can see more clearly. And so here, what do we have in year 1? That's the purchase price. Purchase price is 40.425 million. 40.425 million. 40.425 million plus, let me increase the decimal, 425 million. So 40.425 million. What is our effective interest rate? 6.75. Effective interest rate is at 6.75%. At 6.75%. At 6.75%. Effective interest rate, EIR, at 6.75%. So 6.75% of 100. This is our rate. This is our rate. So I'm going to come here, multiply this on this. So the essence of this effective interest rate is that it will increase the value of that investment. And the moment you pay, so we have our coupon. What's our coupon class? Our coupon is 4%. Coupon is 4%. Okay, 4 divided by 100. So 4 divided by 100 as our coupon. That's divided by 100. Divided by 100. And so we apply it on the nominal value, of the bond. What's the nominal value of the bond? Let's show the workings of that one too. The nominal value of the bond. So nominal value. Our nominal value is what? So 47.25 million. So 47.25 million. And therefore, our coupon value will then be 4% multiplied by this 1.89. So 1.89. So I'll just come here, fix 1.89 here. Our coupon value will be constant all through. So if you are good with Excel, I'm just going to dollarize this. I'll dollarize it. And so with that, I can just continue to repeat it, repeat it, repeat it, repeat it. So it'll be constant all through. So that's the meaning. It's applied on our coupon. And of course, because we are already receiving part of it, so we have to put this one in jacket. So it comes down. It reduces the value of investment because it means we are taking part of the value of that investment. That is what it means. Why effective interest rate will increase, so this one would reduce it. I hope you are following. And so by the time we want to get our amortized cost, what was the value at purchase? Effective interest rate will increase it. And the moment we'll collect this, so this figure goes down. Please look at what I'm doing here. I have minus in front here, and this is plus. So plus times minus will give us minus. So I'm adding all of this. And this becomes our what? It becomes our amortized cost at the end of the period. It becomes our amortized cost at the end of the period. And of course, what was amortized cost at the end of year one becomes the beginning of the amortized cost at the beginning. And of course, the process will continue. I'm going to apply effective interest rate again. So please watch what I do. Effective interest rate. I'm just going to fix this. I will put it in dollar sign. The moment I fix it, I multiply by this. Look at what I've done. It's now applying 0.0675 on 41.265. That is what you have. I'm just going to come here, drag down. Once I drag down, for this year two, you can see what he has done. The opening value, add effective interest rate, less interest received. So this becomes the amortized cost. If you come to year three, let me just follow what I've done here too. So the figure at the end here, the figure at the end becomes the one at the beginning of year three. And you can see that this one will just adjust automatically. And so by the time I compute the effective interest rate for year three, it adjusts further. It adjusts further. And so I'll come here, pick the same thing. So it continues that way. Compute my effective interest rate. So will now be 2.901. This one goes to 41.135. That's the amortized cost. Then, of course, if we end at period 5, so what it means is the amortized cost at the end of period 4 becomes what you have at the beginning of period 5. And of course, I calculate my effective interest yield. I'm going to have 45.224. So this is what this means. So the normal accounting entry that you are seeing here, the normal accounting entry, if you were to pass it, when you purchase that investment, when you purchase that coupon, you have to debit financial assets. You have to debit financial assets. So debit financial asset with the purchase price of 40.425 millions. And which one are you now crediting? You are crediting cash because you are buying with what? With cash. And so you are crediting cash with a sum of what? With a sum of 40.425 million. And so as you have effective interest rate, what will happen to your financial asset is the value will go up. The value will go up by the amount of it will go up by the amount of the effective interest rate. So further, we'll be debiting financial asset. We'll debit financial asset. We'll debit financial asset. Debit financial asset with the amount of the effective interest rate in year one, 2.74. And of course, the moment you do this, P and L will take the corresponding entry. So P or L, profit or loss. So profit or loss will take the corresponding entry. And so you will see me here. Of course, all the figures are in millions. Don't make that mistake. Don't worry. Let me just come here and say 2.729 million. 2.729 million. And of course, I'm going to come here, put the same thing here. Let's not forget our currency. All the figures are in Naira. And be mindful also what you have solved there to say all the figures you have here, they are in what? They're in million naira. Don't make that mistake, I beg you. You made that mistake, it may be an unforgivable mistake. It may be an unforgivable mistake. Unforgivable mistake. So you come here, you also come here, you also come here, you also come here, so that it can be consistent. It can be consistent. So you have this. You can see it's on 2 in naira, it's on 2 in naira, it's on 2 in naira, it's on 2 in naira. So that's the accounting entry. And of course, when you eventually now receive this sum, you are going to debit your cash. Debit cash. You receive the interest. Debit cash of 1.89. So 1.890 million. 1.809 million. And you are crediting where? You are crediting financial assets. You are crediting financial assets. That explains why we were deducting the other time. Deducting from the schedule. So you credit financial asset. No, let me bring it here. Let me bring it here. Let me bring it here. So I credit financial assets. Financial assets. I credit financial assets. So I'm going to come here and put that same figure here. So no, yeah, it's here. So we'll put it here. Yes. So guys, you see that these are our accounting entries. These are our accounting entries, and you place those figures where they are supposed to also be. So these are the accounting entries, and this is what we have. So that is for Steeze, and sorry, for Sapa bond. However, for the Steeze bond, we don't have to travel this route at all. So because it has violated, it did not meet the condition, the nature of the bond, because you want to take advantage of the upward movement in prices and sell same when that is achieved. You are not holding the bond till maturity or for a long time. So it qualifies to be carried, not even at other comprehensive income, but at fair value. So at fair value. So the value have to be adjusted, every now and then. So the treatment for cocoa is, except for cocoa, for Steeze rather, is pretty straightforward. For the Steeze bond, treatment is pretty straightforward, regardless of the effective interest that they have given to you. So the entry normally will just come this way. So when you purchase that bond, financial assets would be debited at what value? It will be debited at 29.4 million. 29.4 million. 29.4 million. So of course, cash will also be what? Cash will also be credited. So that is the normal entry. And when you receive income, the income will be computed based on its own what's it called? Its own coupon rate. And the coupon rate in the question is 5%. Coupon rate is 5%. So if you apply 5% on the nominal value of 31.5 million, nominal value of 31.5 million, that'll be giving us 1.575. 1.575. So change this one to 1.575 million. 1.575. 1.575 become your 1.575. So, and the moment, and because we're told from that question that the bond had a fair value as at the end of the period of 28.75. So 28.875, 28 point what? 875. So what you're not just going to do, class, is to compare that fair value, compare the fair value with the purchase price. And the purchase price is 29.4. So we'll come here and say fair valuation. So fair valuation. We'll come here. What is the purchase price? What is the purchase price? Purchase price. So the purchase price of the bond, as you can see up there, is 29.4 million. Why the market value of the bond? Fair value. The fair value of the bond. The fair value of the bond. Fair value is what? 28.875. 875. Of course, if you subtract this figure, of this, let's put it properly, 8.875. So you'll be having a loss, clearly a loss. So it means that the value of the bond from the amount that you purchased it has gone down by 0.525 million, by 0.525 million. So it has gone down. And so this will hit your pure health. And how will that happen? You are going to be, and of course, debiting your pure health because it's a loss. The entry will now be debit pure health, debit profit or loss. So debit pure health, profit or loss, and credit financial asset. Don't forget, the financial asset was carried at 29.4 million before. So of course, all these figures are in million. Let's not mix them up. They're in millions. So is so all figures are in millions. So what this means, therefore, is that you are debiting your POL with 525, that's 525,000. So 525,000. So they just say 0.525. Of course, all the figures in million, and the financial assets will go down in value by 525 million, so that you can effectively write down 29.4 million to 28.875. That was what I take full responsibility for this. That was probably what I didn't explain very clearly in class. So it's a straightforward thing. It did not meet the satisfaction, of the provisions provided in the standards for us to categorize the second bond as amortized cost, to be carried at amortized cost. So rather, it's to be carried at what? At fair value. And by the standards, so financial assets are of three categories. The ones to be carried at amortized cost, the one to be carried at fair value through or OCI, and the other one to be carried at fair value. I hope with this short video, so clarity that is needed has been given to the mix-up that we experienced in class, for which I sincerely apologize. I wish you all the very best, and I shall await further questions, if any. So do have a great night. Bye.